Donald Trump has just escalated the Iran conflict into a completely different kind of battlefield. And this time, the weapon is not necessarily military force. It is money. The Trump administration has launched what Treasury Secretary Scott Bessent is calling Operation Economic Outcast, a campaign designed to sever Iran's remaining financial and economic lifelines. Bessent described it as an economic D-Day, while Trump has called it the most crushing economic operation ever taken against a country. But here is the part investors need to understand. This is no longer just an Iran story. When Washington begins targeting financial institutions, trade networks, shipping, energy flows, and countries that continue doing business with Tehran, the consequences can move far beyond Iran's borders. And that is where this becomes a potentially important story for oil, inflation, the US dollar, treasury markets, and ultimately gold and silver. Because markets do not wait for the final outcome of a geopolitical conflict. They price the risk of what could happen next. And right now, one of the biggest risks is that economic warfare creates another shock to the global energy system. The United States has warned that countries and entities maintaining economic ties with Iran could face consequences. At the same time, Washington has announced new sanctions targeting dozens of individuals, entities, and vessels across sectors including digital assets, gold, technology, aviation, and shipping. Reuters reports that immediate secondary penalties were not imposed against every country or institution, but the administration has clearly signaled that broader pressure could follow. That distinction matters because there is a huge difference between announcing sanctions against Iran and attempting to force the rest of the global economy to choose between doing business with Iran and maintaining access to the American financial system. If that pressure expands, China becomes particularly important because of its role as a major buyer of Iranian oil. And then we are no longer talking about a simple bilateral dispute between Washington and Tehran. We are talking about global trade, energy markets, and the architecture of international finance. There is another major piece of this story that markets cannot ignore: the Strait of Hormuz. The waterway has remained at the center of the conflict because it is a critical route for global energy shipments. The Washington Post reported that disruption around Hormuz has already affected oil and gas prices, while Iran has threatened further restrictions if the economic campaign continues. Now ask yourself, what happens if economic pressure intensifies, but Iran refuses to back down? Do energy prices rise again? Does inflation become harder for central banks to control? Do investors start demanding greater compensation for geopolitical risk? And if the Federal Reserve is forced to choose between fighting inflation and protecting economic growth, what happens to interest rate expectations? That is where this story gets much bigger than Iran. And that is exactly why gold and silver investors should be paying attention. Because when confidence in currencies, government finances, geopolitical stability, or traditional financial assets becomes harder to maintain, investors historically start looking for assets outside the conventional system. Gold does not depend on the solvency of a government. Silver has both monetary and industrial characteristics. And during periods of geopolitical uncertainty, both metals can attract additional attention. But there is an even deeper question coming next. Could Trump's economic war against Iran accidentally create the very inflationary and financial pressures that make hard assets even more important? This story we need to examine carefully. What makes this situation so important is that Washington is not simply trying to punish Iran. It is trying to change the economic calculations of every country, company, and financial institution that keeps Iran connected to the global economy. That is a much bigger strategy. The latest U.S. measures expand the categories of activity that can trigger sanctions, including digital assets, gold, technology, aviation, and shipping. Around 60 individuals, entities, and vessels have been targeted in the latest round. But there is an important detail that the market needs to understand. The United States has threatened much tougher secondary sanctions against countries and institutions doing business with Tehran, while stopping short of immediately imposing the most damaging penalties. In other words, Washington has fired a warning shot before potentially pulling the financial trigger. And the biggest test of that threat may be China. China has been Iran's biggest buyer of shipped oil, accounting for more than 80% of Iran's shipped oil, according to 2025 Kepler data cited by Reuters. That means any serious attempt to cut Iran's economic lifeline eventually runs into a much larger question. How far is Washington willing to push Beijing? Because if the United States aggressively targets Chinese banks, companies, or energy buyers, the story can quickly evolve from an Iran sanctions campaign into another major confrontation between the world's two two largest economies. And that is where financial markets become extremely sensitive. Imagine a scenario where Chinese buyers reduce Iranian oil purchases because they fear losing access to the U.S. financial system. Iran loses revenue, but global oil supply also becomes tighter. Now imagine Tehran responds by increasing pressure on shipping through the Strait of Hormuz. Suddenly, the market has two opposing forces. On one side, sanctions are designed to reduce Iran's ability to export and generate revenue. On the other side, restrictions around Hormuz can create fear about the physical supply of energy reaching the global market. Reuters has reported that traffic through the strait has fallen dramatically, with oil shipments at a near standstill at points during the conflict. The waterway is strategically important because it carries a huge share of globally traded oil, and this is where the inflation question becomes critical. Oil is not just another commodity. Energy is embedded into transportation, manufacturing, agriculture, logistics, and consumer prices. If crude prices remain elevated for an extended period, the inflationary impact can spread throughout the economy. That creates a very uncomfortable problem for the Federal Reserve. If economic growth weakens while energy-driven inflation remains elevated, policymakers can find themselves trapped between two competing objectives. Cut rates too aggressively, and inflation could become harder to control. Keep rates too high, and economic growth could deteriorate further. This is precisely the kind of environment in which traditional market assumptions can break down. And notice what happened in the market around the latest announcement. Despite the dramatic language surrounding the new sanctions, oil prices actually fell on August 24th and continued lower on August 25th, as traders interpreted the measures partly as a potential path toward de-escalation rather than an immediate supply catastrophe. Reuters reported that oil prices fell more than 2% on Monday and extended those declines Tuesday. That tells us something very important. Markets are not simply trading the headline. They are trading the probability of what comes next. If investors believe the sanctions eventually force negotiations and reopen energy flows, oil can fall. But if the pressure produces retaliation, further disruption around Hormuz, or a wider confrontation involving Iran's trading partners, the market could quickly price a very different outcome. And this uncertainty is exactly where precious metals become interesting. Gold does not need an immediate oil price spike to benefit from geopolitical risk. It can respond to something deeper, uncertainty about the global financial system. When governments weaponize sanctions, financial access becomes a geopolitical tool. Banks, currencies, trade channels, and payment networks can become instruments of foreign policy. And that raises a question that goes far beyond Iran. If access to the dollar-based financial system can increasingly be used as leverage, will more countries begin looking for ways to reduce their dependence on that system? That is where gold enters the conversation. Because unlike a bank deposit, a foreign currency reserve, or a digital payment account, physical gold is not someone else's liability. And if geopolitical fragmentation continues, that characteristic could become increasingly valuable. But silver could be even more complicated. Silver is not purely a monetary asset. It also has major industrial demands. So if this conflict produces higher energy costs and weaker global growth, silver could face competing forces, monetary and safe haven demand on one side, industrial and economic concerns on the other. That is why the next phase of this story matters so much. The real question is no longer whether Washington can hurt Iran's economy. The real question is whether this economic campaign remains contained, or whether it begins to reshape global energy flows, US-China relations, inflation expectations, and confidence in the international financial system. Because if the second scenario develops, this stops being just an Iran story. It becomes a global macro story. And for gold and silver investors, that distinction could be enormous. Now we get to the part of this story that could have the biggest consequences for the financial markets. Because the United States is not simply trying to reduce Iran's oil revenue. Washington is effectively telling the global financial system that companies, banks, and governments helping Iran could eventually have to choose between maintaining those relationships and maintaining access to the US dollar system. That is an extremely powerful form of economic leverage. And it is also a dangerous one. The reason is simple. The dollar is not just America's currency. It remains deeply embedded in global trade, banking, commodity markets, and international finance. So when Washington threatens to remove an institution from that system, the consequences can extend far beyond the original target. Scott Bessent has made it clear that the administration wants to sever Iran's remaining economic lifelines. The latest measures target more than 60 individuals, entities, and vessels, while expanding sanctions exposure across areas including digital assets, technology, gold, aviation, and shipping. But the administration has so far held back from imposing the most severe secondary penalties on major foreign financial institutions. That restraint is important because Washington understands that financial sanctions can create unintended consequences. If you push too hard against one country, you can force other countries to start thinking about alternatives. And this is where China becomes critical. China has remained Iran's most important oil customer, even as U.S. pressure has intensified. Reuters reports that Iranian oil shipments to China fell to roughly 534,000 barrels per day in August from around 823,000 barrels per day in July, although flows have remained significant. Now imagine Washington decides that sanctions are not working quickly enough. The next step could involve Chinese banks, shipping companies, or other institutions connected to Iranian oil. That would dramatically raise the stakes. Because China is not Iran. China is one of the world's largest economies, one of America's most important trading partners, and a major participant in global financial markets. A sanctions campaign that directly targets Chinese financial institutions could therefore create consequences on both sides. And this is where the gold story becomes much more interesting. For decades, the global financial system has operated around the dominance of the US dollar. But whenever geopolitical tensions increase, countries have an incentive to think about reducing their dependence on a financial system controlled by another government. That does not mean the dollar is suddenly going to disappear. It means diversification becomes more attractive. And one of the oldest forms of monetary diversification is gold. Gold is different from a foreign currency reserve because it is not somebody else's promise to pay. It does not depend on a bank remaining open. It does not require access to a payment network, and it cannot simply be frozen because another government decides to impose financial restrictions. That is one reason geopolitical fragmentation can strengthen the strategic case for holding gold. But there is another layer. Look at what is happening to Iran itself. The Iranian rial has fallen to an extraordinary low, approaching 2 million rials per dollar, according to recent reporting. At the same time, Iran is facing severe economic pressure from sanctions, war, and disruption to its energy trade. For ordinary economies, currency weakness can quickly become an inflation problem. And Iran is an extreme example of what happens when confidence in a currency deteriorates. The United States is obviously nowhere near that situation, but investors don't need to believe that America will experience an Iranian-style currency collapse to care about monetary stability. They only need to believe that geopolitical fragmentation, government debt, inflation risks, and financial sanctions are making the global monetary system less predictable. That is enough to increase demand for alternative stores of value, and this brings us directly to silver. Silver is different from gold because it has a large industrial component. That means silver can react to both sides of the macro equation. If geopolitical uncertainty increases monetary demand for precious metals, that can support silver. But if economic growth deteriorates sharply because energy prices rise and trade becomes more fragmented, industrial demand can become a headwind. So silver may not behave exactly like gold. And that is why I would not simply make the lazy argument that war equals higher silver. The real question is what kind of economic environment this conflict produces. If the result is higher inflation, weaker confidence in currencies, falling real yields, and increased demand for hard assets, that combination could be very supportive for precious metals. But if the conflict produces a severe global slowdown without a corresponding monetary response, silver could face much more volatility. Gold may therefore remain the cleaner geopolitical hedge. Silver could become the higher beta expression of the same monetary story. And there is one more signal investors should not ignore. Despite all the dramatic headlines surrounding the latest sanctions, oil prices actually moved lower on August 25th. Reuters reported that oil extended its decline after falling more than 2% in the previous session, suggesting that traders were not automatically pricing the latest sanctions as an immediate global supply catastrophe. That is a very important lesson. Markets are forward-looking. The headline says, economic war. The market asks, does this increase or decrease the probability of a settlement? If investors believe maximum economic pressure eventually forces negotiations, oil can fall and inflation expectations can ease. But if Iran retaliates, if the Strait of Hormuz becomes more restricted, or if Washington expands the campaign toward major Chinese financial institutions, the market could rapidly change its interpretation. And that is the open loop sitting underneath this entire story. The United States is trying to economically isolate Iran. But the bigger question is whether that isolation remains limited to Iran or whether it accelerates a broader fragmentation of global trade and finance. Because if countries begin preparing for a world where access to the dollar system can become a geopolitical weapon, the demand for monetary alternatives could grow. And historically, when confidence in the system becomes more uncertain, one asset keeps appearing in the conversation: gold. But the next question is even more important. If this conflict eventually creates a combination of geopolitical risk, currency uncertainty, inflation pressure, and lower interest rates, what could that mean for the next major move in gold and silver? That is where the real investment story begins. Now we reach the part of the story that matters most for investors, because the biggest mistake would be to look at the Iran headlines and immediately assume that gold, silver, and oil must all move higher. Markets are more complicated than that. Right now, the reaction is actually telling us something important. Oil has not exploded higher following Washington's latest economic offensive. Instead, Brent crude has fallen to around $91 a barrel, while U.S. crude has moved down toward the mid-80s. Reuters reports that traders have largely viewed the latest sanctions as having limited immediate impact on physical oil supplies. That is a critical signal. It tells us that the market is currently pricing the possibility that economic pressure could eventually produce negotiations or reduce the risk of a wider physical supply shock. But that does not mean the risk has disappeared. The Strait of Hormuz remains the wild card. Approximately 1/5 of global oil consumption has historically passed through this strategic waterway, and any sustained disruption could change the entire inflation equation. Reuters reports that Iran has threatened action involving tankers, while an oil tanker was reportedly hit and disabled near Oman on Tuesday. So investors are effectively watching two competing scenarios. Scenario number one is de-escalation. Washington applies maximum economic pressure. Iran's economy becomes increasingly difficult to sustain. Tehran eventually sees negotiations as preferable to continued confrontation. Energy flows improve, oil prices fall, inflation expectations ease. If that happens, the immediate safe haven premium in gold could also cool. But scenario number two is escalation. The economic campaign fails to produce a political settlement. Iran retaliates. Shipping disruption increases. Energy prices rise again. Inflation expectations move higher. And suddenly, central banks face a much more difficult problem, because imagine the Federal Reserve entering a period where economic growth is slowing, but energy prices are rising. That is not the normal environment where policymakers can simply cut rates aggressively without worrying about inflation. This is what makes the Iran situation so important for the precious metals market. Gold does not simply trade on war. Gold trades on the interaction between geopolitical risk, real interest rates, inflation expectations, currency confidence, and investor demand for protection, and several of those variables could move at the same time. If inflation rises because of energy disruption, that can initially pressure gold if it pushes bond yields higher. But if the economic damage becomes large enough to force the Fed toward easier monetary policy, the equation changes. Lower real yields can become a major tailwind for gold. And if investors simultaneously become more concerned about government debt, currency purchasing power, and geopolitical fragmentation, the demand for monetary protection can become even stronger. This is why the Treasury market matters here. The latest Iran developments are arriving at the same time Washington is dealing with enormous fiscal pressures and trying to manage long-term Treasury yields. Reuters reported that U.S. bond yields fell as markets absorbed the Treasury's debt buyback plans alongside the new Iran sanctions. Put these pieces together, you have geopolitical risk, you have massive government debt, you have an administration trying to influence financial conditions, you have potential energy inflation, and you have a Federal Reserve that has to balance inflation against economic growth. That is exactly the type of macro environment where gold can become much more than a simple geopolitical hedge. It can become a hedge against policy uncertainty itself. And then there is silver. Silver is where things become considerably more interesting. If gold begins another major advance because investors seek monetary protection, silver can potentially amplify that move. But silver also carries industrial exposure. That means silver investors have to watch the economic growth side of the equation very carefully. If this situation resolves peacefully and global growth remains healthy, silver could benefit from both monetary demand and industrial demand. If the situation escalates and creates a major global slowdown, silver could initially underperform gold because industrial demand becomes a concern. But if policymakers respond to that slowdown with easier monetary conditions, falling real yields, and additional liquidity, silver could later catch up and potentially move much faster. That is why I would separate the two metals. Gold is the defensive monetary asset, silver is the higher volatility monetary and industrial asset. And there is another reason I think investors need to pay attention to what happens next. The United States is attempting to use the dollar-based financial system as leverage. Treasury Secretary Scott Bessent has explicitly warned that countries and institutions facilitating Iranian transactions could face exclusion from the dollar system, while the administration says it wants to sever Iran's remaining economic lifelines. This creates a fascinating long-term question. Could aggressive use of financial sanctions actually encourage some countries to accelerate accelerate diversification away from dollar-based systems. That would not mean the dollar suddenly loses its global dominance. That is far too simplistic. But it could mean that central banks, governments, and large institutions increasingly value assets that sit outside another country's financial liabilities. And that brings us right back to gold, because gold does not require a counterparty. It does not need a payment processor. It does not depend on another government's promise to honor a debt. That characteristic becomes more valuable when geopolitical trust declines. So the Iran story may be creating two different investment narratives simultaneously. The short-term narrative is about oil, Hormuz, inflation, and the Federal Reserve. The long-term narrative is about financial fragmentation, currency diversification, and confidence in the global monetary system. And if both narratives begin moving in the same direction, precious metals could find themselves at the center of a much larger macro trade. But there is still one final question. What happens if Trump's economic operation succeeds? Because that outcome could actually create a completely different path for gold and silver. If the pressure forces a settlement, oil falls, inflation cools, and geopolitical risk declines, precious metals could lose some of their immediate risk premium. But if the opposite happens, if economic warfare fails, Hormuz remains restricted, energy prices rise, and policymakers face another inflationary shock, then the market could suddenly begin pricing a much more complicated monetary environment. And that is where the next major move in gold and silver could be determined, not by the headline saying economic war, but by what this economic war does to inflation, interest rates, the dollar, and global confidence. So where does all of this leave gold and silver investors? The answer is not as simple as saying that an economic war against Iran automatically means higher precious metals prices. The real opportunity and the real risk comes from what happens next. Right now, the market is sending us two very different signals. Oil is telling us that traders do not yet believe the latest U.S. sanctions will create an immediate global supply shock. Brent crude has been trading around the low $90, while U.S. crude has remained in the mid $80. But gold is telling us something else. Gold has climbed to around $4,700 an ounce, reaching a 3-month high as investors worry about inflation, fiscal policy, and instability in the bond market. And that divergence is extremely important, because it suggests investors are not simply buying gold because they expect oil to explode. They are buying gold because they are worried about something much broader. They are worried about the combination of geopolitical uncertainty, inflation, government debt, financial policy, and the stability of traditional markets. That is the bigger story. And if the Trump administration succeeds in forcing Iran toward a settlement, we could see oil prices continue lower, inflation expectations moderate, and some of the geopolitical premium come out of gold. That would be the bearish short-term scenario for precious metals. But there is another scenario. Suppose the economic pressure fails. Suppose Iran continues resisting. Suppose the Strait of Hormuz remains disrupted. Suppose energy markets tighten again. And suppose Washington responds with even broader financial sanctions against countries and institutions connected to Iran. Then suddenly the market could face a combination of higher energy prices, renewed inflation pressure, and greater geopolitical risk. That would be a very different environment. And it could become particularly complicated for the Federal Reserve. Because if inflation is rising while economic activity is weakening, policymakers have very limited room to maneuver. They could keep rates higher and risk damaging economic growth, or they could ease policy and risk allowing inflation expectations to become less anchored. Neither option is comfortable, and this is where gold could become extremely important. Gold is already showing that investors are willing to pay a premium for protection against uncertainty. If fiscal concerns, bond market instability, and geopolitical fragmentation continue at the same time, the argument for gold becomes much stronger than a simple war hedge. It becomes a monetary hedge. And that distinction matters, because wars eventually end. But debt, currency dilution, fiscal deficits, and financial fragmentation can remain for years. That is also why the long-term implications of Operation Economic Outcast could be larger than the immediate sanctions themselves. Washington is effectively reminding the world that access to the US-dominated financial system can be used as an instrument of foreign policy. For countries that depend heavily on that system, the message is obvious. But for countries trying to reduce that dependence, the incentive to diversify becomes stronger. And one of the oldest forms of monetary diversification remains gold. The United States does not need to lose dollar dominance for this trend to matter. Even a gradual increase in demand for assets outside the traditional financial system can have significant consequences when central banks, sovereign investors, and institutions are involved. Silver presents a different opportunity. If global growth remains relatively resilient while monetary and geopolitical demand for precious metals increases, silver could potentially benefit benefit from both sides. But if the Iran conflict creates a severe economic slowdown, silver could initially be more vulnerable because of its industrial exposure. That is why I would not chase silver simply because the headlines sound bullish. I would watch the macro indicators, watch real yields, watch the dollar, watch oil, watch inflation expectations, watch the Federal Reserve, and most importantly, watch what happens around the Strait of Hormuz, because that is where the entire narrative could change. If Hormuz stabilizes and diplomacy returns, the immediate geopolitical premium can fade. But if shipping disruptions intensify and energy inventories continue to tighten, the market could suddenly begin pricing a much larger inflation shock. Reuters has already warned that emergency oil reserves have been heavily drawn down and that continued disruption could put a floor under crude prices. That is the risk investors cannot ignore. So my base case is this: do not trade the headline, trade the consequences. The headline says Trump has launched an economic offensive against Iran. The deeper story is that the United States is testing how far financial power can be used to reshape geopolitical behavior. The next question is whether Iran bends, retaliates, or finds enough support from trading partners to withstand the pressure. And the answer to that question could determine whether this remains a geopolitical headline or becomes another major macro catalyst for commodities and precious metals. For gold, the setup remains structurally interesting because the metal is already responding to broader concerns about inflation, fiscal policy, and financial instability. For silver, the opportunity may be larger, but so is the uncertainty. If monetary demand accelerates while industrial demand remains healthy, silver could potentially outperform gold. But if the global economy deteriorates sharply, silver may experience much greater volatility. Either way, one thing is becoming increasingly clear. The Iran conflict is no longer just about missiles, oil, or sanctions. It is becoming a test of the global financial system. And when financial warfare, geopolitical fragmentation, inflation, and massive government debt collide, investors eventually start asking one question: what assets remain valuable when confidence in the system itself begins to weaken? That is exactly why I believe gold and silver deserve attention right now. Not because every headline guarantees a rally, not because war automatically makes precious metals go up, but because the world is moving into an environment where monetary, fiscal, and geopolitical risks are increasingly connected. And that is the environment where hard assets can become much more important. As always, these are macroeconomic observations, not personalized financial advice. Verify the data, understand the risks, and do your own research before making any investment decision. Because the biggest mistake in markets is not missing the headline. It is missing what the headline is really telling you,